Hi students, how are you? Today we are going to discuss new accounting standards, that is property, plant and equipment. Property, plant and equipment IAS 16, that is International Accounting Standards 16, and Sri Lanka Accounting Standards 16. Same, both are same, but small difference may be there. But in most of the cases, both are same. Okay. So, hi student, hi students. How are you? Today, I am going to discuss a new accounting standards, that is property, plant and equipment. International IAS 16, that is International Accounting Standards 16, and Sri Lanka Accounting Standards 16, that is SLAS 16. Okay. So, what is property, plant and equipment? First of all, we have to see what is the property, plant and equipment. That is, the definition for property, plant and equipment is held for use in the production, right? Held for use in the production or supply or goods or services for rental or to rental to others, or for administrative purposes. For the administrative purposes, the property, plant and equipment in the sense held for use in the production, that is machinery used in the process of production, or supply of goods or services for rental or others. Supply of goods or services, maybe you can rent out the assets to the third party, or you can use the property or plant and equipment to deliver the produced goods to the respective people, right? For administrative purposes, for the administrative purposes, that is office is used for the building, office building used for the administrative purposes, that is that will be recognized as the property and plant, right? And expected to be used during more than one accounting period, expected to be used more than one accounting period, that is we are going to use, what is the accounting period? It is 12 months, right? That may be January to December or April to March, next year March, that depends, right? But accounting period should consist 12 months, right? 12 months period, right? That means expected to be used more than 12 months, right? More than 12 months. That those, if these two conditions are satisfied, that equipment or property or plant, yeah, that asset is recognized as property, plant and equipment. So now you got an idea as to what are the assets are recognized as property, plant and equipment. For the if you say for held for use in the production process, that is machinery that is used for the production purposes, right? Or supply of goods or services for rental to others, that means car or vehicles, right? We can say vehicles in common, vehicles, right? And for administrative purposes, building, building and maybe vehicles also, building and vehicles, etc. These all will be used more than 12 months period, right? All these assets have the lifespan of more than 12 months. So in that aspect you are clear, right? Then we have to see what is the second part is measurement, right? Definition of asset, what is a property, plant and equipment, and second part is measurement, right? Measurement will be divided into two. One is initial measurement and subsequent measurement. Initial measurement and subsequent measurement. During the initial measurement, right, we will see what is the initial measurement, right? Subsequent measurement will be divided into cost model and revaluation model, that we will see later on. Initial measurement in the sense cost of purchases, right? Cost of purchase, cost model, like that cost model. But what are the costs incurred in the purchase of the asset? That is purchase price, right? Cost. And second one is any taxes will be involved, right? Any discounts, trade discounts, right? Trade discounts, all these factors has to be looked into. All these factors has to be included in the calculation of cost. Initial measurement has to be included in the initial measurement. Any taxes in the sense taxes with a non-refundable taxes. These taxes, what I prescribe is what the accounting standard says, non-refundable taxes. Some taxes are refundable taxes. I mean, for value added tax, that is refundable. For some people it is refundable, some organizations it is not refundable, right? That is depends on their turnover, right? So how they have registered with the VAT, exceptional or honorary or something like that. So prices we have to take into consideration. Any taxes we have to take into consideration. Any taxes in the sense non-refundable taxes, right? Non-refundable taxes and trading discounts, right? We have mentioned, and any other dismantling cost, dismantling the inventory, dismantling the inventory cost, that also has to be taken into the consideration when we are doing the initial measurement. This is the initial measurement. So you may have got an idea of initial measurement of an property, plant and equipment. Okay, so that is initial measurement. And subsequent measurements are, there are two models in subsequent measurements, that is cost model and second one is revaluation model. Okay, cost model and revaluation model. In the cost model, what we do is, cost, already we have calculated the initial cost is there, right? Initial measurement is there, no? That is the initial measurement cost is here in subsequent measurement. That with the initial cost we have to deduct the accumulated depreciation and accumulated impairment, right? accumulated depreciation and accumulated impairment we will see in later on. What is depreciation, right? How do we depreciate the asset, and what is the impairment, and what is the carrying value? After deducting the depreciation and impairment cost, we arrive at a carrying value, right? Carrying value. So normally accumulated depreciation, in the sense, depreciation normal idea I will give you. If the vehicle, if the asset has a useful life, every assets during that period we can when we are looking into depreciation we will see that, otherwise it is the waste of time, right? Okay, so next one is revalued value, revaluation. That also we will look into the later. Revaluation is we are valuing the asset market value, right? That is a revaluation, right? If revalued, whole items in the same class of assets has to be revalued. If one item in the equipments is revalued, if the one item of the building is revalued, all the buildings has to be revalued, right? Not the equipments, or the building class. If you revalue the office building, you have to revalue the factory building also, right? You cannot revalue only the office building or only the factory building, right? All the buildings has to be revalued. That is what they have mentioned, right? Now, before we come to the revaluation of property, plant and equipment, we will do some sums, right? In the question number 1, they says, right, John's purchased a machine that had a list price of 100,000 but was offered a trade discount of 10%, right? John purchased a machine. Further settlement discount 5% available if payment is made within 15 days. John also incurred the following charges in getting the asset ready for its intended use, right? Shipping charges, right? Shipping, handling charges, pre-production testing and site preparation costs, general overheads, right? Included in the site preparation costs is 3,000, which is as a result of John's providing incorrect requirements for the asset, right? Calculate the initial cost of machine to be recorded in accordance with the SLAS 16 of the property. Okay, what they do is, okay, John's purchase an item, okay, purchases price is his purchase price. He is purchasing an item, John's, right? John's purchases 100,000 worth of goods at the 10% off, 10% discount. That means 90,000, right? 90,000. If we settle within 15 days, within 15 days, 15 days, he will get another further 5% discount. Further 5% discount in the sense 5,000. Then it will be 85,000. Right? 85,000. But in the question they have not said, they had not mentioned how the payment is made, how he has settled the amount, whether he settled within 15 days or not. If the examiner is silent in that case, we have to take it as a 10% off, right? Machinery, machine purchases, right? Machinery, right? Purchases, purchases 90,000. Okay, 90,000. Okay. So pre-production testing charges, pre-production testing charges, that is 12,000, as it is 12,000 we have to take, right? Other one is site preparation cost, right? Site preparation cost, site preparation cost, right? 3,000 included as a result of Jones providing incorrect requirements. So we have to deduct that 3,000 from 17,000. From 17,000 we have to deduct 3,000. That is because of the wrong information that cannot be capitalized, right? So 14,000 we have to take, right? Site preparation, right? And other thing is shipping and handling charges, 3,500. Shipping and handling charges are 3,500. 3,500 shipping and handling charges. And they have mentioned general overheads, right? General overheads. General overheads you cannot take into consideration. General overheads cannot be included. It is not general overheads you cannot take into. This is not relevant to production. So general overheads we had to exclude it, right? This is 500 and 7 9 9,000 9,000 and 10 119,500 is the cost value, right? Total value, total cost is 119,500. This is the way you have to calculate the cost. Here we have taken discounts, 10% we have taken, right? We have excluded the irrelevant portion of the expenses because site preparation expenses 17,000 total, but out of 17,000 they have incurred 3,000 because of providing a wrong information, right? Wrong information. So actually they should have incurred 14,000. So we have to take only 14,000. This the 3,000 is excess unnecessary expenditure, right? That is not relevant to the product cost, right? So in the product cost we had to, not the product cost, the what you call machinery cost we cannot include it. So this is for the question number 1. We have completed the question number 1. Because of this you know how to calculate the measurement, initial measurement. What is the initial measurement? You may know now what is the initial measurement, right? So second question we will see. We will see what are the other questions. Next one is depreciation. We have to see the depreciation, right? Now I am raising this one. Now we will say what is depreciation. If we see what is depreciation only, we have seen the initial measurement. Now we are entering into the subsequent measurement. We are entering into the subsequent measurement. In the subsequent measurement, there are cost model and revaluation model. Cost, we have already have done the cost, and we have to see what is the accumulated depreciation. The accumulated impairment, now at this stage it is not necessary for you, so I am not going to discuss accumulated impairment. Impairment, we have a separate accounting standards for the impairment. When we are doing the impairment, when we are doing the standards, impairment standard, at that time we will do the accumulated impairment. What is the accumulated impairment? At that time you will do, and at that time you will understand. If I go for the accumulated impairment, it is time not worth for time, right? This carrying value, right? Now we will see under the cost value we have a depreciation. Depreciation in the sense, the all the companies have the assets cannot be used for the lifelong until we die, right? Humans have a lifespan, right? The humans, if you say for us, we have a human lifespan of 60 years or 70 years. 70, after 70 years or 60 years or 80 years, we may die, right? We will call off from this world. So likewise, each property, plant, equipments have a limited lifespan. They have also lifespan. After that we cannot use that. If you say vehicle, approximately that depends on your usage, the lifespan may be 10 years or 15 years, like that. After that it will become a obsolete asset. Obsolete asset in the sense it cannot be used, right? Like that. So if we are purchasing an asset, property, plant and equipment, okay, property, plant and equipment, for there will be a cost incurred, right? There will be cost incurred. At the same time, this cost has to be amortized or depreciated. Cost has to be depreciated. Because when we are doing the profit and loss, when we are calculating the profit and loss, we have to include the cost incurred for using this property and plant and equipment during the accounting period. During the accounting period, for the usage of the property, plant, equipment, the cost relevant to the property, plant and equipment has to be accommodated into the profit and loss account. Then only we will see the correct profit and loss account, right? Because if you say this property, plant and equipment we can use for 10 years, 10 years, up to 10 years only we can use. That means useful life. This is the useful life. Useful life. Otherwise you can say lifespan. Useful life, life span of the asset, right? So we will mention this is in different terms. Useful life 10 years. After 10 years we cannot use this property, plant, right? This property, after 10 years we cannot use this property. So after 10 years, can you, up to 10 years, can you mention, can you state the property, plant and equipment at its cost? No. At the end of the years, when you are disposing only, you are going to charge it to the profit and loss? No. You have to distribute that cost within this all, for all 10 years you have to distribute. That is what we are calculate the depreciation, right? There is a in the depreciation also we have the straight line method, straight right line method, and diminishing method, right? Most of the cases we go for the straight line method, right? So the cost has to be amortized equally. If you go for the straight line method, equally in 10 years. So every year you will have the cost portion will be charged to the profit and loss account, PNL, right? PNL, we will charge it to the PNL, and in the balance sheet, accumulated depreciation, first year depreciation, depreciation when you are making the depreciation account debit expenses, and accumulated depreciation account credit, that is accumulated. If you say every year we are making a depreciation for 100, and second year 100, and third year 100, and for the PNL we charge it to the PNL only 100. Every year 100 we will be charging to the PNL. In the balance sheet, first year we will have 100, second year it will be 200, right? Third year it will be 300. That is what we have said, accumulated depreciation. Depreciation account debit, accumulated depreciation credit, no. So the accumulated depreciation, we will, property, plant and equipment cost is there, we will deduct the accumulated depreciation from the cost, right? Then the written down value, correct value will be there. At the end of the 10th year, there won't be a, this asset will be the nil balance, it will show the nil balance. So it is the true value. We are presenting a correct profit and loss during this period because of this accounting standard. These accounting standards are regulating this, right? So depreciation is in the sense, now you would understand, right? Depreciation in the sense, each asset will have a useful life. Useful life cost, we have to cost divided by useful life, useful life, then we will get the depreciation amount for the year, charge for the year, charge for the year, right? For straight line method, right? Charge for the year. This is what we mentioned, the property, plant and equipment. When we are doing the depreciation, the accounting standard says, when you purchase an asset, you may purchase any organization may purchase the asset, right, during the accounting period, during the accounting period, right? During the accounting period. And at the right during the you may purchase the assets during the accounting period, right? Or would I purchased in previous year? Like previous year, you would have purchased previous year, right? You would have disposed disposal of assets during the year, selling the, right? This is called selling. Selling the assets during the year. So there are three types of transaction may take place based on assets, right? The purchase of asset, right? Not the purchase of asset. Sorry, an asset could be purchased during the accounting period. Could be purchased. An asset could be purchased during the accounting period. An asset could be purchased, could have been purchased in previous year. An asset may be disposed during the year, sold during the year. So during this situation, during the year, if you are purchasing the asset during the year, you have to calculate the depreciation from the date of purchase, from date of purchase to end of accounting period, right? You have to charge depreciation according to the accounting standards. If you have purchased during the accounting year an asset, if you say accounting period is 1st January 2022 24 23 to 31st 12th 23, right? In this case, if the person purchases on 1st of June 23, then you have to calculate the depreciation for month number 6, 7, 8, 9, 10, 11, 12. That's for the 7 months only. 7 months only you had to calculate the depreciation. For the 7 months only you had to calculate the depreciation, not for the whole year. You had to calculate the depreciation from the date of purchase of that assets to end of accounting period, right? So that is that. So 7 months according to this. And second one is purchased and in previous year. Previous year in the sense, if you have purchased the asset from the in the previous years, in the sense you had to calculate for the whole 12 months. Whole 12 months. Right? Whole 12 months you had to calculate. From the date, starting date of accounting period, depreciation, start date of accounting period to of end date of accounting period. Start date and end date. Right? Understood? If the disposal of assets taking place during the year, in the sense, date of disposal, from the starting date, depreciation should be calculated. Starting date, starting date of accounting period and to end of accounting period, right? End of accounting period, not the end of date until to date of disposal of the asset, right? Then if we have purchased, if you sold the asset, right, middle part, month for the one, month number 12, at the month number 4 you are selling, disposal take place, that means 31st 4th 23. Then you have to depreciate for the 4 months, 4 months 4 months only, not the whole year. For the 4 months only. This is start date of the accounting period, this is the disposal date, then between this only you have to calculate the disposal. Okay, so now you may got this. So I have given some rough ideas. This is the way of explaining you that as depreciation and what you call as a depreciation calculation date periods, how to calculate when these three type of transactions takes place regarding the asset. Okay, so I am going to raise this one. Okay, next we can do the sum, right? Next we can do the sum. Question number 2, that is on change in useful life, change in useful life. Life, right? Useful life. Change in useful life. Right? That is question. In that question they says on he has bought an item property. A who is that? A changes in useful life. Mr. X, right, bought an item of property, plant, and equipment for 25 million. The X bought property, plant, and equipment, property, plant, and equipment for 25 million, right? 25 million on 1st January, on 1st January 2019, right? 2019 bought, right? So the item will be depreciated for 10 years. Useful life, useful life, right? Useful life is 10 years, 10 years, right? 10 years. On 31st December 2021, right? 20 2021, 31st December 2021, right? The assets remaining life was estimated to 5 years. Useful life decided to 5 years. 5 years on this date, right? So calculate the amounts to shown in the financial statements of X for the year ended 31st December 2022. 31st December 2022. Right? Right? So on so we had to calculate the annual depreciation, right? Annual depreciation, right? Annual annual depreciation. Annual depreciation workings, right? Yes, no? Annual depreciation depreciation is 25 million divided by 10. That is 2,500,000. 2,500,000. Right? So 2019, 12, 13, 2019, 20 and 21. Right? So up to 3 years. Depreciation for right? So we have to identify property. He bought the property, plant and equipment of 25 million. Useful life is 25 years, 10 years. Right? So annual depreciation we have calculate for annual depreciation, that is 2,500,000. Right? The useful life of the property, they has revalued the useful life of the property as 5 years on 31st 12th 21. Right? Then here we have to calculate the depreciation for 3 years. So the carrying value of the asset, carrying value of the asset as on 31st 12th 21. Right? So 19, 20, 21, 3 years. Right? That is 25 million, right, minus how much, 2,500,000 into 3 years, right? Because per year depreciation, straight line method, so there is no confusion. So per year is 2,500,000, for 3 years 7,500,000, right? So 25, then you will arrive at 25 million minus 7.5 million, 17,500,000. 17,500,000. Right? 17,500,000. Right? So now new depreciation, new, this is old and new annual depreciation. Depreciation is, that is 17,500,000 divided by new useful life is 5 years, right? 5 years, right, divided by 5. We say first of, yes, 31st of 12, right? Then we will arrive at how much, 3, 15 and 5, right? So 3,500,000, 3,500,000. New depreciation is 3,500,000, right? So they wanted to know new depreciation is 3,500,000. So the carrying value, the carrying value of the asset as on 31st 12th 2022 was 17,500,000 minus 3,500,000. Right? Then it is 14 million. 14 million. It is 14 million. This is the value. So what they have asked? They ask calculate the amounts to be shown in the financial statements for the year ended 31st December. This is the carrying value you have to show in the financial statement. Right? Have you understood? Here, the annual depreciation on the useful life is changed on 5th, right, on 31st 12 2021. So 31st 12 2021, the value carrying value is 31st 12 21, the carrying value is 17,500,000. So we are calculating the new, right, new depreciation. This is the old depreciation. And new depreciation, then it comes to 3 million. 70,500,000 divided by 5 years. Then carrying value of the asset as on 31st 12 21 is this. That is 70,500,000 minus 3,500,000. That is the amount. This is the question number 2. If you want, you can take it down and I am going to raise it. Okay. Right? Changes in number 3. Question number 3. Changes in accounting policy. Okay. This question deals with the changes in the accounting policy. Next question. Right? We will see. Change in the method. Change in the method policy. Accounting policy, not depreciation policy. Changes in depreciation method. Right? So here in number 3 is lorry was purchased for 80,000 on 1st January 2020, right? 2020. 1st January 2020, right? So no, sorry, 1st January 2018, right? 2018. Right? And right, 2020 18. So useful life was estimated to be 10 years with the residual value of 10,000. The depreciation policy of 20% on, right? So 20% The lorry was purchased on 80,000 on 1st January 2018, and its useful life was estimated to be 10 years. Residual value is 10,000. The depreciation policy of 20% on straight line method, reducing balance method, 20% was selected on 1st January, right? On 1st January 2023, the directors have now decided to give a fair presentation, a depreciation policy of straight line method over the useful economic life should be allowed. So there has been no changes in the estimated useful economic life of the asset as a result. There has been no changes in the economic useful life, right? So they have purchased an item on 1st January 2018 at lorry for 80,000, right? On 1st of January 2023, right? 23 or 22, sorry, 22, right? 22, right? 18, 19, 20, 21, 22, right? 22, 5 years, right? So 22, first of June, they decided to go for the straight line method. This is reducing balance 20% and reducing method, or diminishing balance method. Now they decided to go for the straight line method. Useful life remaining unchanged for 10 years, right? So we have to calculate the asset value as at 31st 18, 19, 20, 21, 20, 18, 19, 20, 21, 22. This is 23, right? No, 23. 5 years, right? 23. So we have to, if it is 23, 18, 19, 20, 21, 22. Up to 22 of December, we have to calculate the depreciation, right? First, cost value. Cost is 80,000, right? Cost is 80,000, right? So first 31st 12 18 2018, the depreciation is at the rate of 20%. Then 20% in the sense 16,000. 16,000 reduce 16,000. Then we will arrive at 64,000, right? Depreciation on 31st 12th 2019, depreciation on 64,000, right? 64,000, how much is the on 64,000, 20% is 12,800. 12,800, if we deduct 12,800, then 200 and 3 1, 51,200, right? Then 31st 12th 20 depreciation at 20% on 51,200, 20% on 51,200, 10,250, 10,240. If we deduct this, we will get 60, and this is 11 9 and 504, 40,960. On 31st 12th 21 depreciation 20% is in the sense, right, that is 8,192, 8,192. This 8 6 15 6 and 8 7 2 3 32,100 32,760. That is 31 12th 21 depreciation 20% is how much? That is 6,554. 6,554. If we deduct this one for 1 2 and 6 to 26,214, this is the carrying value as on 31st 12 22, right? So they decided to change the accounting depreciation depreciation method to straight line from this date, from on 1st of January 2023, right? Balance is 26,214. 20% on this is not 20%. We have to calculate the straight line method in the sense 26,000 depreciation for the year. Depreciation per annum, right? Useful life is 10 years. Out of 10 years, 1 2 3 4 5 years completed. 5 years we have completed, and another balance 5 years is there. So we had to divide 26,000 depreciation per annum, right? Depreciation per annum is 26,214 divided by 5. That is equal to 26,214 divided by 5. It is 3,243. 3,243. This is the new depreciation. So carrying value. So depreciation carrying value as on 31st 12th 23 was no first January 23 was 26,240. Right? Depreciation on 31st 12th 23 is 26,214 divided by 5. right? That is equal to 3243. This is the 1 11 7 11 9 2. This is the carrying value as on 31st 12th 23, right? As on 31st 12th 12th, right? This is the way. This is the answer. So here changes in the accounting method or depreciation, changes in the depreciation method not going to affect the previous year. The cutout is take place here, right? Cutout is take place here, right? This is the balance as on 27. This is asset. Up to this one we have carried out straight line method, right? Straight line. Reducing balance method. Reducing balance method, right? Here straight line method. Nothing is changed, only the percentage depreciation amount is changed, right? Only the depreciation amount is changing. Other than that everything is okay. There we are not going to adjust the prior transactions, right? So from this onwards we are changing our accounting policy from out, but we had to disclose it in the financial statements, right? About the changes took place. Okay. In this next we will see revaluation of property and plant equipment, right? Revaluation, when you are doing revaluation you will get the revaluation gain or revaluation loss, right? In the revaluation gain also it is subdivided into previously revalued, and if it is previously revalued and revalued gain, there is a division, and revaluation previously revalued loss, right? In the revaluation gain, previously not revalued, that also there. For previously if it is not revalued we will say property plant and equipment debit and revaluation account credit. That is the new revaluation taking place for that property, right? The double entry also I have given, right? Previously not revalued, that means this is a fresh very first revaluation taking place. So for that property plant and equipment account debit by revalued amount, excess amount, and revaluation reserve account credit, right? Revaluation reserve account credit. And other thing is previously revaluation done and gain is there, right? Then property plant and equipment account debit, revaluation reserve account credit, that is also there, same as this. But when the revaluation previously revaluation loss, and if you are doing the revaluation and if you are getting a gain, revaluation previously revalued gain is there, previously revalued loss is there, right? Property plant and account is debited. If it is gain you have to credit it to previous loss, has to be credited to the profit and loss reserve or profit and loss account, and credited balance amount has to be credited to the profit and loss reserve account. Sorry, reserve, revaluation reserve account credit, right? If you say you have a previous loss, previous revaluation loss of 50, 100 rupees, you have a previous revaluation loss of 100, right? So that would have been in the revalue profit and loss reserve account, right? Is decreased profit and loss reserve account. So this year you are getting a revaluation profit of 200, right? So 100 will credit to the profit and loss, and balance 100 only you will transfer it to the revaluation reserve, right? This is the double entry we will do for previously revalued, right? This is as it is. And if you say revaluation loss, previously revalued, right? Revaluation loss, previously revalued, and previously revalued gain is there. Previously revalued gain is there. If that is the case, revaluation reserve account debit, right? Revaluation reserve account debit, that what you call revaluation gain, right? Right? You have a gain previously revalued, and now it is gain, and now it is gain, but revaluation is loss. If it is a revaluation is loss, profit or loss account debit, property plant and equipment account credit, right? Credits here, right? Credit. If you are loss, right? Here you are incurring a loss, right? Revaluation loss, but previously you have a revaluation gain. If it is a gain, you had to set off that gain in the revaluation reserve account. Revaluation reserve account debit, and balance has to be credited in a P&L, and property plant equipment account credited. Loss. Previously revalued loss. Then P&L debit and property plant account credited. Okay, that is the double entry. Double entry also I have given here. Right. So next we will see change of accounting policy. No, change in useful life. Right. Change in useful life. Change in question number 2. Change in useful life, right? I bring my they called, wait will you, fourth, revaluation, right? Fourth question is revaluation. Revaluation, they said Charles bought a building on 1st January 2015, right, for 500,000, right? 1st January 1st, wait, 1st January 2014, right? Purchase set for 500,000. 500,000, right? With an estimated useful life of 25 years and no residual value, a straight line method of depreciation was adopted on 1st January 2017. 1st January 2017, right? Charles decided to revalue all non-current assets in line with IAS 16, right? The building was revalued at 600,000. The useful economic life is unchanged. 600,000. Revaluation. Revaluation. 600,000. Right? Now they ask us to show the revaluation would be show how the revaluation would be accounted for in the financial statements for the year ended 31st December. So statement of before going for the statement of this thing, we had to see how to work it out. Right? They show the revaluation would be the accounted for in useful life. Right? Working. Here we will prepare a chart, right? Before going for the statements, right? We will prepare the workings, right? Working. Another working, we description, right? Description and what you call yes, description, historical cost, historical cost, right? And revaluation, revaluation and revaluation surplus. This is revaluation surplus, right? So if you prepare the statement like this, right? Right? We had to know the purchase cost, cost on 1,121,4, right? Purchase cost is 500,000, right? Here revaluation on, right? So depreciation useful life is how much? 25 years. Useful life is 25 years, right? Then depreciation is 500,000 divided by old depreciation. 500,000 divided by 25 years. This is to 20,000. Right? 20,000 per year. Right? So on straight line method, 2014, 15 and 16. For 3 years we had to calculate the depreciation. So depreciation, right? 20,000 into 3. 20,000 into 3. That is right. We would see whether 3 years or 6 years. Right. This is to 2016. Right. Revaluation take place on 2016. Right. So 14 and 15 only 2 years only we have to take. 2 years. Right. 2 years. Then if that is the case, yes, 2 2015, right? Not 15, not 14. This is 17. This is 15, right? 15. 15. Then 2015 and 16. 2 years. 2 years in the sense depreciation is 40,000. 40,000 we had to deduct. Then 460,000. This is asset carrying value. Carrying value, C, I will put CV, right? Carrying value on first 2017, right? 60, right? Revaluation, right? Revaluation, and revaluation take place how much? 600,000. 600,000. Revaluation is 600,000. See, 600,000 on carrying value as on 1st January 2017 is 460. Here's revaluation 600. So what is the revaluation surplus? 140,000. 140,000 is the revaluation surplus. Right? If you prepare like this, it will be easy for you to tackle any type of questions in this related to this. Right? So 140. So we had to make a depreciation for the year, for the 2017, no? Up to 2017 they wanted to prepare the account. So depreciation for 31st 12 17. How much? Depreciation now the depreciation, the old depreciation is, right? We will put like here, old depreciation calculation is 500,000 divided by 25, that is 20,000. Right? New depreciation is now 600,000 divided by how many years we have gone through? 2 years we have gone through. Out of 25 years, 2 years we have to deduct, and 23 years is the balance. It is the amount that we have to make a depreciation, right? Make a depreciation, right? Carrying value, carrying value on first 1 20 20 18, right? 18, right? So we will see what is the depreciation amount. 600,000, 600,000 divided by 23, it is equal to 26,087. 26,087. 26,087. You have to deduct this, right? Here the depreciation would be 20,000 earlier, right? Earlier. So what is the incremental value is 6,087. 6,087 has to be deducted from the surplus. It has to be deducted from the surplus. So if you deduct this one, 3, 1, 9, and 9 out of 6 is 3, 9 out of 7, 573,913. This is 13, 913, 9 out of 6, 3, 13, 133,913 is the revaluation surplus account balance, right? So this is the workings. Our workings is this. This we have completed the workings, right? Other one is statement of profit and loss and statement of financial position, right? This is statement of P&L. This is statement of financial position, right? This is go to the P&L, statement of profit and loss, SOPL, right? This goes to the statement of financial position, right? This go to the revalued reserves or other comprehensive income, other comprehensive income, right? This 100 and 687, right? So this is the one. So here we will see increased, right? 20 to 26. Under the statement of profit and loss account, we will say what is that? Depreciation. $26,087. Under the statement of financial position, you will say what is a building, no? This is known as building, right? Buildings, building, 600,000, 26,087, so 573 and 913, right? Statement of changes in equity. In that, and revaluation surplus, brought forward retained earnings, right? Revaluation surplus, that means revaluation transfer, $140,000, right? Reserve transfers, right? Reserve transfers 6,087 here, 6,087, right? This is the statement of changes in the equity. Equity, retained earnings and revaluation surplus, right? Statement of changes in equity, retained earnings and revaluation transfer 140,000, reserve transfers 6,087. This is non-current assets, non-current assets, right? This we had to mention, right? This is a non-current equity. I had to mention revaluation surplus, that is 133,930, right? That is, I have left it out. This all, that's all, right? Finished. And we will move to the, I am going to raise this one and we will move to the next question. Okay, next question. Question number 5, disposal of revalued assets. Right? Disposal of revalued assets, right? William bought building on 1st January 2015. 1st January 2015 bought an What is it? Building 400,000, right? 400,000 building for 400,000. Okay. Wait. Right. Okay. 400,000 with an estimated useful life of 25 years. For 25 years is estimated useful life. So on 1st January 2017, 1st January 2017, right? He decided to revalue all non-current assets about this one, and revalued by amount is 500. Revaluation 500,000, right? Right, on 1st January 2019, 1st January 2019, disposed the asset 550. Disposal for 550, right? 550. So depreciation straight line method, right? Okay. Now we will, as earlier, we will put description, this description, description, and what is that? Description column, right? Historical cost, historical historical cost, right? Evaluation, revaluation surplus, revaluation surplus, right? On cost on 1 2015 is 400,000, 400,000, and depreciation up to 16 31 12 2016, right? 5 and 15 and 16, 2 years, right? So 400,000 divided by 25 into 2, 2 years, right? That is how much? That is how much? 400,000 divided by 25 into 2 is 32,000. Sorry, 32,000, right? That is 32,000. Then we will arrive at 368,000, right? As on 1st of 1 2017, right? The revaluation amount is 500,000, 500,000, nothing, right? So 8 17 and 18, again 2 years, right? Depreciation for 2 years, 500,000 divided by 2 years only we have completed out of 23, then 23 divided by 23 into 2, right? Depreciation up to 31st 12 2018, right? What is the amount? 500,000 divided by 23 into 2, that is also 32,000. 32,000. Sorry, this is 32,000. This is 43,478. 43,478. Right. So here, carrying value on 1st of March 2019. Carrying value, right? 522, right? 9 6 9 5 456,022. Here revaluation is not here. 132,000. 132,000. Here out of 32, if you deduct 11,478. 11,470 is the incremental depreciation. Then 522, 1 is 0, 2, 120,522. 120,522. Right, this is the value for this. Okay, correct. We will write the profit on disposal. Profit on disposal is equal to, what is that? Disposal amount is 550,000 minus 456,522. This is the profit on disposal. Okay, so in the, this is the profit we have generated from the disposal. In the statement of profit financial position, nothing is there. In the statement of, what you call, statement of yeah, statement of profit and loss, we will show profit on disposal. Profit on disposal, 93,470. 93,470. Right? Statement of, and change, statement of changes in equity. Statement of changes in equity. That also nil balance, but we had to show. That is a requirement, right? Description, historical cost, description and retained earnings, revaluation, reserve, right? Revaluation return, retained earnings and revaluation reserve. Okay, brought forward brought forward. Retained earnings we don't know. Revaluation reserve we brought forward 120,522. Right, on 1st January 2019. Right, and reserve transferred, reserves transferred for, yes, we will get retained earnings will get 120,522 and revaluation reserve will be close 522. Revaluation reserve debit, right, and retained earnings is credit. That is the journal entry. Opening balance we don't have, that's what we haven't shown in the balance sheet, right. Revaluation account, revaluation reserve account credit and retained earnings account, sorry, revaluation reserves account debit and retained earning account is credited with the surplus we have transferred, right. So here profit is shown under the profit and loss statement, the profit on disposal, that is 93,470. Surplus is revaluation surplus is transferred to the retained earnings. Okay, here since it is on written down value, we don't need to consider about the accumulated depreciation and so on and so forth. Okay, so I hope to meet you in another accounting standards lectures sessions in next time. Okay, thank you, take care, bye.